Leverage is when a fund will borrow money at a lower rate than the return they're trying to generate out of the fund. So, for example, in our National Diversified Fund, our goal is to make 17 to 20% annualized returns for you. So, one technique I could do to boost the amount of return is I could borrow money, let's say at 8%, and I might be able to even give you better returns yet. I think that adds a layer of risk that I'm not comfortable with in this stage of the market cycle, so we do not use leverage with our long term fund. There may be a time in the future where it's appropriate. Today isn't that day. Our short term income fund uses a small amount of leverage, it's less than 10%. But it's not to increase the returns. It's more just as a liquidity vehicle to match up supply and demand of capital. What I mean by that is the short-term income fund makes hard money loans to people doing fix and flips or other types of renovation projects in real estate. And each month they might originate 10 new loans and they might have 10 loans that get paid off. So they've got to match the cash flow timing of these 10 loans coming in. When they get paid off, this cash is coming back into the fund, and the cash going out of the fund is the 10 new loans that we're about to write. Sometimes the timing on that isn't exactly perfect, and the cash needs to go out before the cash comes in from a payoff, and that's when you use a line of credit as a way to smooth out the cash flow. So the only leverage that we use is the short-term income fund. It's a very limited amount, and it's only for that purpose.